So our concentrator for today is Gary Moyer. And Gary is the managing partner of a business law firm established in 1968. He's one of two owners of the firm and practices in the area of commercial real estate, business transaction, and estate planning with a niche in estate planning for business owners. He's married with 3 grown children and 3 grandchildren. He is AV rated with Martindale-Hubbell, the highest rating given by that go-to lawyer rating service. And just before I introduce him, I just want to give a quick testimonial for him. Gary helped me with my AC issue in my landlord and feeling a little uncomfortable talking to attorneys. I don't know about you, but he made it so simple for me and was really able to help me a great deal with that. So with that being said, I'd like to introduce you, Gary Moyer.
Well, thank you, Vicki. I appreciate that. Let me share this. Did that work?
Yes.
Yes.
Okay, beautiful. All right, so we're a small law firm here in San Diego, been in San Diego a while. Me and my partner, Mike Weinstein, are the owners. So we're second generation. Ferris and Britton are each retired. Generally, our clients are closely held businesses and commercial real estate owners. I'm going to talk about estate planning, though. Well, I'm going to talk about personal. First, my beautiful wife, the day we got married, and then at her oldest son's wedding. And so the 3 kids, 2 boys and 1 perfect child, I say. The youngest is my daughter. And she is engaged to be married in August of next year. Apparently, with COVID and weddings being what they are, the wedding venue tells you when you're going to get married. You got to fit 2 years of weddings into 1 year next year. So they chose August for us. This is my middle guy, Spencer. He is trouble. He is trouble. Always was. Oh, this is him playing against Michael Thompson of the Golden State Warriors in high school. So when he played at Chico State, now he's a commercial real estate guy, selling apartment buildings. And he used to be in San Diego, the Western Regional Manager for Marcus and Millichap. Now he's moved back to Sacramento with his beautiful wife. They have 2 babies now. That's my oldest, Grayson. Oh, that's him playing against UCLA. He went to Humboldt State, Division II school. Oh, but the little sports town he went to, Arcata, where Humboldt's located, they love their little college there. He got on the side of the van at the sporting goods store. And this is him against Luke Walton and Richard Jefferson. They had a 3-on-3 tournament up in Carlsbad. His team actually won that tournament, beat Walton and Jefferson. And he played in Germany for a while. Now he's a CPA with a beautiful wife and a little boy. We vacation in Mexico for a amount. That's my stinking Lincoln Continental, the boat. Love to fish, love to drink. All right, this is basically the firm. And 9 attorneys. And we do general business. We have folks that do just employment, folks that do just litigation. And I don't do either of those. And then commercial, because I can't keep up with the employment laws. And I don't like litigation. My job is to keep people out of litigation. So a lot of commercial real estate, a lot of corporate. There's a lot of merger and acquisition stuff going on right now. And a lot of estate planning. And so my estate planning niche is for the business owners. And so since we've been around a long time, a lot of our clients are just long-term clients, especially the business clients. We do one-off estate planning. It's not just that we only do estate planning for business owners, but where we do estate planning for business owners, oftentimes We also represent them in their general business. So estate planning is doom and gloom, but this applies, it applies to everyone in this room. You have, and I'm a believer, of course, but you really do owe it to whoever your spouse, your kids, whoever it is that's, you owe it, your leaders in your family, you owe it to have your affairs organized so that if the unlikely, the unexpected occurred, you don't leave behind a mess. If you don't do anything, if you don't have an organized estate plan and you get hit by a bus or you get incapacitated, it's a mess for them. And they're going to wonder why the heck you didn't take the modest amount of time that it takes to do estate planning. You just have to get it done. Oh, and it's not a tax issue. It's really not anymore. We'll see what happens. I'll talk about that next. But right now, there were less than 2,000 taxable estates in 2020. So not very many. Because the highlighted portion there is you don't pay death taxes. So death taxes are separate from income taxes. You don't pay, no one pays death taxes unless their net worth on death basically exceeds the exemption. In 2021, the exemption is 11.7 million. 11.7 million. So for a husband and wife, that's 23.4 million. So most people, that's why there were less than 2,000 taxable estate tax returns in 2020. So estate planning generally is not about death taxes. It's about making sure your affairs are in order. Number one, who you want to get stuff and how you want them to get it, more so than taxes. The only caveat to the $11.7 million figure is two things. One, under current law, it's set to be cut in half on January 1, 2026. And also, with a Democrat in the White House, his tax plan that he put out when campaigning was to cut back the exemption. He didn't specify how much. It's at least in half. Some people worry it might be 3.5 million, but it's going to go, a lot of people think it's going to go up. Now, so who knows what's going to happen. So, but it's not, paying taxes is not a problem for most people. So you have to deal with lifetime issues in estate planning, mostly dealing with if you're incapacitated. You can't handle your own affairs. You need to name someone to make healthcare decisions for you. Let's see. And you need to, I have two screens. What are you guys seeing? Are you seeing numbers on the screen or are you seeing something else? My screen's gotten, I've lost control. All right.
They have depends for that, Gary.
So estate planning, a vanilla estate plan is a revocable trust. Basically, it's a fancy will. You can change it anytime you want. It's ignored while you're alive. You still have a will. You should have power of attorney for healthcare. Name someone to make healthcare decisions for you if you can't make them for yourself.
Gary, you lost control because you were only showing a very small picture. So I put up your PowerPoint at full view so everybody could see it. That's why you lost control for a second. But you can go back to show it as long as you go to slide view so everybody can see it properly. So you can feel free to share again, but I'll help you to make it bigger. It was too small.
Okay, thank you, thank you. So you need it, even with a trust, you need a power of attorney for property as well as for health. So if you can't go back. Let's see how can I help you? Slide 40 I'm on, Robert.
I will go to slide 40.
And then you transfer, the way a trust works, you transfer your assets to yourself, comma, trustee of your trust. And again, the trust is ignored during your lifetime. It doesn't file a tax return or anything like that. All right, the next slide is basically for married folks, the choice is all the spouse. You give everything to your spouse, or what's called an AB trust. Since 2012, there's no longer a detriment. There's no longer basically a penalty for giving everything to your spouse. It's more simple, and there's a tax benefit of you get a step up in basis. If for death tax purposes, when you, under current law, when you die, let's say you bought your home for $100,000 30 years ago, and now it's worth $1 million. If you sold it the day before you died, that'd be $900,000 of gain. And there's a special exclusion for your residents, but generally you'd have $900,000 of gain. Whoever inherits that from you gets a step up and gets their basis in that property. Forget the $100,000 you paid for it 30 years ago. Their new basis is adjusted to the fair market value of the assets. So including securities, including real estate, anything you own, with a little caveat exception for IRAs. And so if somebody inherited that house, I talked about that's worth $1 million now that I bought for 100,000 30 plus years ago, the heirs get it for $1 million, get a new basis for $1 million. If they sold it the next day, they'd have no income tax gain or loss. So that's a big deal, a step up in basis. So the reason to do the more simple all the spouse is there's a second step up in basis when the second spouse dies. A downside of the all the spouse is if I die and give everything to my spouse, she may change the estate plan to something with which I would not have agreed. She may get remarried. She may give it to her new husband. And that's a downside of the all the spouse, that the surviving spouse can change it. And so a lot of times, especially where there's kids from a prior marriage, that the first spouse to die wants to protect the inheritance of those kids, wants to take care of the surviving spouse, but wants to ensure that anything left that the surviving spouse doesn't need to consume goes to the kids from the prior marriage. Then the all the spouse is not a good plan. There's also no creditor protection in the all the spouse plan. If I give everything to my wife, her creditors could get, she owns those assets with no strings attached, and anybody could, her creditors could attach those assets. So, Robert, I'm on slide 44 now. The AB trust is the other fundamental choice for a married person. That's as compared to the all the spouse. So the AB, one more slide, Robert. The AB sets aside my stuff. Generally, if it's everything's community property, sets aside my half in an irrevocable trust, a trust that cannot be changed. And it used to be the standard before they changed the rules in 2010, basically. And so if your estate plan is old, before 2010, you should go back and look at it to see if you have the AB spouse plan. For a long time married couple, where there's no prior marriage, kids from a prior marriage, most go with the all the spouse estate plan. Again, it's more simple, and you get to step up a step up in basis on the second spouse to die also. That's a big deal. But there's reasons to do an AB spouse. One, where I mentioned if I'm hypersensitive to my spouse getting married and giving my half of the stuff she got from me to her new spouse, then I park my stuff in an irrevocable trust. And I could make my spouse the beneficiary of that irrevocable trust. She could also be the trustee. So she, as trustee, she'd have discretion to make distributions to herself as beneficiary. So that's quite a bit of control. It's not an ATM where she could take it out for any reason or no reason, but it protects her. If she needs the money, it's there for her. A benefit of the AB spouse is that what's left in that irrevocable B trust, my stuff, what's left of my stuff, goes to who I designated before I died. So kids or whatever it is, if it's kids from prior marriage, for instance, it would be guaranteed to go to them. Another benefit of the AB trust scheme is the assets are protected from the claims of creditors of my spouse. So they can't force their way into those assets. My wife's creditors, my widow's creditors can't get those assets to pay her bills. The downside of the AB trust is it's a lot more complicated. And because you have two trusts, the surviving spouse needs to remember the A spouse, which has the surviving spouse's stuff in it. Instead of my stuff goes to the B, my wife's half of everything goes to the A trust. She can do anything she wants with that. The B's in an irrevocable trust. It has its own tax ID number, files its own tax return. And so she's got to remember she can do anything she wants with A. B, it's slightly more limited. She can't use it as an ATM to consume those assets for any reason or no reason. If she needs them, they're there for her. So it's more complicated. It's much more complicated if you try, for instance, if the house is half in A and half in B and she tries to refi it, it's really complicated to get a loan against real estate that's in an irrevocable trust. The second downside of the AB trust is when my wife dies, the stuff in the B trust, my stuff that I set aside for her in that irrevocable trust, do not get a second step up in basis to their fair market value on the date of her death. So that second step up in basis can be a big deal depending on how long my wife survives.
I saw something in the remote control drawer.
I did not hear that. I did not catch that. So, again, for husband and wife, fundamental choice, all the spouse versus AB. All the spouse has a lot of benefits in terms of simplicity and a second step up in basis. The risk is the surviving spouse does something with the assets with which you don't approve. In that case, if you feel strongly about that being a risk, go to the AB trust. Now you get to, okay, husband and wife each died and or a single person dies. The question is, what happens to the stuff? And in this case, for instance, there's still, the simple thing is to, if there's kids, to give it to the kids in equal shares, free of trust, no strings attached. But if you have young kids, if they're too young to get an inheritance, and depending on the number, if it's a big number, they're not financially mature enough, a lot of folks don't want to give it to a kid that's not financially mature enough. If it's a big number, they don't want to give it free of trust, no strings attached. In that case, you leave it in trust for that child. Let's say I have 3 children, so I set up 3 separate trusts, one for each child, 3 silos, they're each separate. They each start off equal in value. A benefit of that approach, again, is if they're too young and they just blow the money, then it's kept in trust. They can't control it. The trustee controls it. Let's say my brother's a CPA, I name him as the trustee. And he doles it out to the kids as they need it for purposes he thinks I would approve of. College education, things like that, getting married, buying the first house, stuff like that. A benefit of that, keeping it in trust for the kids, is it's protected from claims of their creditors. I think that's kind of a big deal. So their outside creditors can't force their way in and get into that inheritance. So it's a protected safety net for each child. And again, there's 3 separate trusts, in my case, 1 for each child. And with litigious society, I like the prospect of having it protected from the claims of their creditors. Now, each of my children could be, let's say they're old enough that but for that creditor protection concern or benefit of keeping it in trust, that I would give it to them free of trust. It's not that they're 20 or 21 or 25, they're older. I'd give it to them free of trust, but I like the idea of being able to protect it from their creditors. I can make the child the trustee of his or her silo. So each child can be the trustee of his or her silo. The child as trustee would have discretion to distribute income or principal from that trust to the child as beneficiary. So again, that's sort of like Trust B with the surviving spouse. That's quite a bit of access to those assets if they need it, even though the assets are in trust, but it's not an ATM that they can take money out for any reason or no reason. A lot of times the clients, they can keep it in trust for the child's entire lifetime if they want to. If you have big numbers, you do that, keep it in trust for the child's lifetime. And then at their death, specifies it goes to your grandchildren from that child. The reason to do that, that's called a generation skipping trust. The child, when the child dies, is not treating as owning the assets in that child's silo. So it's not counted against that child's exemption that I talked about before. So it skips that child's generation in terms of death taxes. So when you're talking big numbers that will make a difference in death taxes, you should consider generation skipping trust. Keep it in trust for the child's entire lifetime. And at the child's death, it goes to that child's children. Again, during their lifetime, the child could be the trustee and the beneficiary. And as trustee, have discretion to make distributions to the child as beneficiary. Some people, though, say that the child's not going to have a net worth above that IRS exemption amount. So I don't need to keep it in, I don't need a generation skipping trust. I don't need to keep it in trust for that child's entire lifetime. I'm just worried that they're too young right now to get it. So give it to them half at 35 and half at 45. In those ages, and the percentage given to them at any specific age is arbitrary. I like at least 2 tranches, only because it gives the child, frankly, a chance to blow it and learn from blowing it. If they get hundreds of thousands of dollars or $1 million at age 35 and blow it by the time they're at the second tranche, in my example, age 45, when they're getting a like amount, then they've learned from that bad experience not to do that again. They're more careful with it. Again, the longer you keep it in trust, as long as it's in trust, it's protected from the claims of that child's creditors. In my example, where they get it free of trust outright, half at 35 and half at 45, then the trust goes away at age 45. There's nothing in it. The child owns those assets in the child's individual name. By operation, and I put when I say protection from creditors while it's in a trust, I put ex-spouses in the category of creditors. If they're divorced while the trust is in place, my child gets divorced, the ex-spouse doesn't get anything that's in that trust. By age 45, in my example, where it's distributed free of trust, by operational law, it's my child's separate property because an inheritance is an exception to the general rule that anything acquired during marriage is community property owned 50-50 by the child and the spouse. And inheritance is an exception to that rule. So the inheritance is my child's separate property when it comes out of the trust to the child. But it's easy for the child to convert it to community property. There's no tax consequences to doing that. And if I don't like my child's spouse, or the child's spouse, he or she spends, money like it's water running through the hands, I either delay the distribution out of the trust so that it's a safety net for my child, or I have a heart-to-heart with my child and say, look, when that money comes out of the trust to you, I have a heart-to-heart before I die with the child, that don't commingle it. Keep it as your separate property. My little speech is that it only matters whether it's separate property or community property if you divorce. If you die, you should give everything to your spouse and kids anyway. So the distinction between separate and community property only matters on divorce. And I'm giving you this gift. I prefer that you keep it as your separate property. Again, if you care. Some people don't care. All right, I'm on the next slide, the business, yeah. So the business does take special care. It's, if only one, first of all, if you're single, you need to specify what happens to the business. If you're married, but your spouse isn't involved in the business, you need to, just like a single person, you need to come up with a plan. You need to communicate either to your key employees or who's going to manage your financial affairs, who's going to be the trustee handling the administration of the trust, what you want to happen to the business. You know better than anyone who to contact, or either your key management or your spouse. So I use a letter of instruction to say, here's the investment banker, business broker, whatever you want to call it, that's best. Here's the 3 best ones that know my little niche industry. Because there are investment brokers that have niche industries. If you have co-owners, you should have a buy-sell. That's real. That's common. You got to have a buy-sell. If you have co-owners, if you don't own under 100% of the business. And if you own 100% of the business, you need to give some guidance as to what should happen on your death. You know best. And that's part of the succession, estate planning aspect on succession for estate planning. Don't be like these famous and frankly rich people who died without a will. It's terrible. It's just a mess. Actuarially, it's not likely to happen, but estate planning is the what if game. Just what if something did happen? Don't be like these people and not have your affairs in order. Oh, I got to mention one thing. I've got a couple of minutes. Prop 19 just passed on November 3rd. That's a big deal. The old rules allowed the parents' property tax base in California real estate to carry over to their children. And if your parents have held real estate, the parent generation held real estate for a long time, that's a big deal. The spread between the property tax base and fair market value. Represents a lot of property tax savings, that spread. parent-child exclusion used to be unlimited as to her personal residence. So if I gave my personal residence to my kids, my property tax base would carry over to them. And obviously, the longer you held the real residence, the bigger the spread would be, the bigger the property tax savings would be. So it used to be parent-child exclusion, parents unlimited as to the personal residence, and up to $1 million of property tax assessed based as to other property. So not only my residence, but if I own 2 commercial properties that I bought a long time ago, and they're rented out as office buildings or whatever, the kids could inherit up to $1 million of property tax base. And again, property tax base is unrelated to fair market value. So those 2 commercial properties, I may have bought for $400,000 a piece 25 years ago. Their fair market value may be $5 million collectively, but the property tax base, 400,000 times 2 is 800. It's cinched up over, 1 or 2% a year to be $1 million, but their fair market value is $5 million. Under the old rules, residence unlimited value and $1 million of property tax base I could give to my kids. They get that property tax base not only in my residence, but to the 2 commercial buildings. That's the rules until February 21st, 2021. That's the rules. The new rules only have a parent-child exclusion for a residence, number 1, only a residence, not the 2 commercial properties that I talked about. Only applies potentially to a residence, only up to $1 million of fair market value of the residence. So if my house is worth more than $1 million, it's not going to qualify for the full parent-child exclusion. And the kids have to live in the house as their principal residence. So effectively, there is no parent-child exclusion. It's a rare circumstance that somebody's going to check all those boxes where the kids are actually going to live in the house. So that's a big deal. That's a big change. Property taxes is a big deal. I have a lot of buy and hold clients that have held real estate for a long time, and I've used the property tax exclusion. I have one client who saved $375,000 in property taxes using this parent-child exclusion under the current rules before they change on February 21 next year. $375,000 in 1 year. So it's a big apartment building. So every year, and folks in that client situation in the future that die after February 21 are not going to be able to avail themselves of that. It's much more limited. So that, I just want to make you aware of it. So some people are thinking, well, maybe I should do something with my house before February 21, before the new rules kick in. And frankly, if the kids are just going to sell the real estate, it doesn't matter, because the buyer of the house or the commercial real estate, in my example, 2 commercial properties, if the kids are just going to sell it and take the cash, then it doesn't matter. The new buyer is going to get new property tax base. But if they're going to hold the real estate, the parent-child exclusion is a big deal. All right, so this is the end. The takeaway giveaway. 1, find your estate planning documents. That's often the challenge for folks because they haven't looked at them in a while. 2, feel free to email them to me. If you want a free look at them, I can tell you based on my experience what it currently provides and give you perhaps food for thought as to changes to consider. And it's free. I mean, why not? If you can't find your estate planner, you don't have one, then 1, shame on you. But 2, you really should have something in place. It's peace of mind. I tell people it's peace of mind, if nothing else. knowing it's there. You won't need it, actuarially speaking, for 30 years, whatever the number is, but you have the peace of mind knowing it's in place, and it's the right logical thing to do. All right, that's it for me. Thank you.
That's great information, Gary. Do you have a few minutes for any questions?
You bet.
Do we have any questions out there?
Good question.
I'm sorry, I didn't see who that was.
It's Ken.
Ken, go ahead.
Hey, Gary, for the Prop 19 change, is that regardless of if the property is being transferred through a trust? Is it regardless of any type of transfer?
Yeah. Yeah, that's a big deal.
Okay, and that go you said that goes into effect in February.
Yes.
Okay, because I have a situation that's like that right now that we're going to be. So is it from the February date for the time of
Transfer.
death?
For
When
the
that goes into
transfer
effect?
in real estate. So you can make, it applies to gifts during lifetime, not just a death. I mean, you don't have to die. If you make a gift during a lifetime to kids, the same parent-child exclusion rules apply. So that's why people are thinking about, instead of waiting till I die to give the real estate to the kids, they're considering whether it's complicated though. I mean, if the kids own my house, you know, I don't want to, I got to lease it from them or something. I don't want to go with my hands out to my kids if I, you know,
Gotcha.
it's complicated, you know. But it's at least something to consider, at least have on your radar so you know. Michael CDO had a question having to do with, do you recommend having a pour over will? If so, can it avoid probate if under 150,000 of net worth? So generally, I talked about this trust, a revocable trust, that's a fancy will. As part of that estate plan, you still have a will, and it's called a pour over will. It pours over into the trust. So yes, part of the estate plan is having a pour over will. There's an exception. So let me give you the down and dirty estate plan that you don't need an attorney for. One is put things in joint tenancy. If you're married, joint tenancy with your spouse, right? So that when you die, by operational law, it goes to your spouse. That's what the words joint tenancy mean. You just show a death certificate. If I die, my wife shows a death certificate, and it goes by operational law to her. That includes real estate. Same thing on a brokerage account. Let's say I'm single. You can use payable on death as to the brokerage account with Bill McCall. You have $2 million in a brokerage account. You could say payable on death to the 3 kids. And you can, until your death, you can obviously change it, do anything you want with that brokerage account. But it's a way to avoid probate and avoid setting up a trust. Payable on death. I call it a poor man's estate planning. It's good, but what if a kid has a drug problem, a creditor problem? The kids are too young. You know, that's when you need it. A payable on death goes to the kids free of trust, outright, no strings attached. If there's any concerns about the kid's ability to handle that inheritance responsibly, then a payable on death or a joint tenancy with a kid is not a good solution. Then and Michael mentioned $150,000. Generally, you can avoid probate for non-real estate assets of $155,000 or less. So by what's called a small estate affidavit. So one, it doesn't apply to real estate. It applies to everything else that would otherwise go through probate. If that stuff that would otherwise go through probate is worth $155,000 or less, and it changes over time by a cost of living adjustment, then you can use simply a small estate affidavit. You give the bank, even though it's in my name, my will says it goes to my wife. My wife has to wait 40 days after I die, then gives the bank the small estate affidavit. And if the money in the bank account and all the other stuff that would otherwise be subject to probate's under $155,000, then with that piece of paper, my wife can get all the money in the bank account. She has to wait 40 days. But the point is, you don't have to go through probate just for that bank account, for instance. Doesn't apply to real estate. So there are alternatives. You got to do something. You got to think about this stuff just in case. You got to at least have joint tenancy payable on death. You know, the right way to do it, estate plan's not that much in terms of money. You know, it's important stuff. Usually you're dealing with kids, a spouse, or at least siblings or whoever is going to get your stuff if you don't have kids or a spouse. It's important stuff. That's my pitch.